Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my initial research checklist. Today, we're shining the spotlight on Badger Meter, ticker symbol BMI, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. To date, I've screened 229 stocks across 9 sectors and 70 industries, with a mean quality score of 59% and a top quartile benchmark of 70%. I evaluated Badger Meter in August 2025, and data used for this episode is as of Q2 25. They earned a 81% quality score, which was good enough for the 92nd percentile overall, and tied 15th, which earned them a pass rating. Okay, so let's now discuss their business. According to the GCIS classifications, they are in the electronics general industry within the larger information technology sector. Their market cap as of 8/25/25 is $5.5 billion, which places them squarely in that mid-cap category. Badger Meter was incorporated in 1905 by a group of Milwaukee businessmen to address the growing need for accurate water measurement in the frigid northern U.S. climate. The company began as a traditional water meter manufacturer, but over time has expanded to smart water technologies, flow instrumentation, and connected solutions. Today, Badger Meter is recognized as a North American leader in smart water solutions. Think of them as an industrial tech company squarely on the utility and industrial water markets. They're essentially a pure play on municipal water infrastructure, the way Moody's is a pure play on credit ratings. Growth has historically been driven organically, supplemented by bolt-on acquisitions in smart metering and IoT. And at this point in its journey, Badger Meter clearly sits in the mature growth stage of the business lifecycle, established, cash-rich, and steadily compounding. Now, Badger Meter sells smart water meters, flow instrumentations, and analytics software. Think of their meters like the cash registers of water utilities. They measure every drop and turn usage into billable data that helps cities manage one of their most critical resources. In terms of who they sell to, they are a B2B company, and their primary customers are municipalities, think city governments that operate public water systems, and water utilities, which could be public or private entities that manage water distribution and billing, along with a few select industrial clients. Badger Meter's products are essential. Utilities can't bill customers, detect leaks, or manage infrastructure without accurate metering. Their revenue base is also quite diversified. No single customer makes up more than 10% of sales, according to their latest 10K. They earn revenue primarily from hardware sales, water meters, sensors, and flow instrumentation. But the mix is shifting towards software and recurring revenue through offerings like Beacon AMA, which is a cloud-based analytics platform, and Orion Cellular, which is a network as a service or NAAS. Now, this SaaS recurring layer is small today, but growing as utilities modernize their infrastructure and adopt smart networks. According to the latest 10K, they recognize revenue in 2 different ways, and 93% of revenue is recognized in a point in time. Their hardware sales are recognized when products ship and control transfers to the customer, which is pretty straightforward. But then they also have around 7% of revenue that they call over time. This is software or SaaS subscriptions, potentially monitoring services, and auxiliary support that are recognized ratably over the life of the contract. This slice is what makes Badger Meter feel more like an industrial tech hybrid than a traditional water meter manufacturer. Most contracts use fixed pricing with minimal variable consideration. Now, in terms of their revenue drivers, the first one is infrastructure replacement, and this is where utilities need to upgrade their aging meters to smarter solutions. They also have something, if you read their investor presentation decks, around non-revenue water savings. And this is when utilities reduce water loss to leaks or inefficiencies, and it creates that clear ROI for adopting BMI tech. And then the digital transformation and this demand for real-time billing, leak detection, and conservation analytics. Then in terms of pricing power, I do have this as moderate. I believe utilities are cost conscious, but Badger Meter's accuracy, regulatory compliance, and high switching costs give it room to push through consistent price increases. And importantly, meters fall into utility CapEx or maintenance budgets. And according to my research, it's only about 1 to 3% of the slice of total expenses, yet they're still mission critical. That mismatch, in my opinion, makes it easier for BMI to raise prices without jeopardizing adoption. However, it is worth noting that they do have a high sales cost. From my research, municipal contracts often require long RFP processes, integrations, and onboarding. Now let's turn our attention to their business segments and geographies. Badger Meter reports as a single operating segment, but it does disclose results across 2 product lines, and they are utility water and flow instrumentation. Now, utility water makes up around 88% of sales, and this was as of fiscal 24, which was up from around 85% in 2023. This is the company's core franchise. It includes water meters, radio endpoints, and smart metering solutions like Orion and Beacon SaaS. These systems form the billing backbone for water utilities while also improving leak detection, conservation, and that regulatory compliance we talked about. Growth is driven by long-term industry shift from manual and AMR meters to what they call AMI smart networks, where around 40% of US meters have been upgraded so far, at least according to their latest 10K. Higher margin products like software, ultrasonic meters, and water quality sensors are gaining share within this line. The other product line, flow instrumentation, is only around 12% of fiscal 24 sales, which was down from 15% in 2023. This line serves broader industrial and commercial markets, and their products include meters, valves, and sensors used to measure and control fluids like water, air, steam, and other gases. Applications span water, wastewater treatment, HVAC systems, corporate sustainability programs, and general industrial processes. While smaller in scale, this line is probably compelling for larger industrial conglomerates searching for acquisitions. In terms of geographies, Badger Meter is essentially a US pure play, with around 90% of revenue tied to American utilities. International markets are small but important. Europe leads abroad, while the Middle East was the standout growth region in 2024. Just to break it down a little further, the United States made up around $745 million fiscal 24, which, as I mentioned, was 90% of sales and 20% year-over-year growth. And this was driven by ongoing utility upgrades to AMI smart metering systems and strong demand for water quality sensors. Now, on the international front, this made up around $81 million in fiscal 24, as I mentioned, 10% of sales, and that was down 1% year over year overall. And when you break it down by region, the growth was a little mixed. So Europe is the largest at 37 million, or around 4% of sales, but they were down 5% year over year. And then the Middle East, as I mentioned, only 17 million, which is 2% of sales, but it was up 62% year over year and worth monitoring in future quarters. And then we have Asia, Canada, Mexico, and other that are around 1% of sales, and they were all down year over year. Overall, Badger Meter remains a US-centric company with modest but strategically important international exposure. The Middle East is emerging as a bright spot, while Canada, Asia, Mexico, and others pulled back in 2024. Badger Meter doesn't have a Morningstar rating, but most frameworks see it as a narrow to wide moat, driven mainly by switching cost and regulatory stickiness. In terms of switching costs, I rated this very high, as I believe that once meters and AMI systems are installed, utilities will rarely switch. And then I do believe there is some regulatory moat here, as approvals and procurement hurdles would probably slow competitors. Let's now turn attention to one of my favorite areas, research and development. Every great company reinvests in itself, but not all R&D spending is created equal. For Badger Meter, it breaks down like this. From an absolute spend perspective, they only spent around $19 million in R&D in fiscal 24, which was way below peers like Itron at $215 million and Xylem at $230 million. So their spend is pretty tiny in absolute dollars compared to some publicly traded competitors. However, if you look at it as a percentage of revenue, they still are pretty low at around 2.3% in fiscal 24, but Xylem is around 2.7%, and Itron is actually higher at 8.8%. So on a relative basis, they compare quite well to Xylem, but they're much lower than Itron, which from my research is a little bit more of an R&D intensive business, given their electric and gas grid focus. Now, my favorite way to break down R&D is to look at R&D efficiency. And you can check my tweets or Twitter for the equations, but it's essentially revenue growth percentage divided by R&D percentage with a little bit of lag. And in fiscal 24, BMI's R&D efficiency was around a 7.6 ratio, and they've been consistently strong since 2021. This was actually higher than Xylem at 7.2x in 2024, and way higher than Itron at 1.7x in 2024. The way to look at this is that you want to be over 1, and the good news is that they all are, but BMI leads the pack, as they are able to turn relatively small R&D dollars into outsized revenue growth. Now, I don't look at this for every company, but just a little bit of discussion around supply chain and operations. Badger Meter does manufacture many of its meters and instruments in-house, but they still rely on third-party suppliers for key raw materials. Its products depend on metals and alloys, notably copper-based brass, plastics, glass, and electronics. While most inputs come from multiple suppliers, the company does depend on single sources for certain brass castings, resins, and subassemblies. So this does potentially expose it to cost swings or quality risk, but they do mention that they have business insurance to help mitigate some of this. Now, a strong company is only part of the equation. You also need a great industry with tailwinds. So let's take a closer look at the landscape Badger Meter operates in. So I give their industry attractiveness a very attractive rating. And I believe this because they have barriers to entry and many secular tailwinds, including digital transformation, aging infrastructure, sustainability mandates, and global water scarcity that is driving growth. According to Durable Value Creators' blog post, Badger Meter pegs its own TAM at around $20 billion, with about half of that tied to software-related opportunities. Independent estimates are a little narrower. External research places the global smart water metering market at roughly 4.7 to 6.7 billion in 2024, and this is from Precedence Research and Bluefield Research. So this is a relative small market size versus some other companies that appear in this podcast. Using the lower estimates of current TAM, Badger Meter's revenue share of the global market is around 13 to 19%. Its 10K further notes that together with Xylem and Roper, the quote-unquote big three control around 85% of the US water meter market. I then like to look at a little bit of growth forecast and compare analyst forecasts for Badger Meter to the industry overall. Now, there's 18 analysts from InvestorsGrow.com that pegs Badger Meter at an 8.5% revenue CAGR through 2029. So this is having them jump from $926 million in 2025 to $1.3 billion in 2029. Precedence Research projects the global smart water metering market at around 11.7% CAGR through 2034, with North America growing at the fastest CAGR. And this is due to AMI penetration, forecasted to rise from about 40% in 2024 to nearly full adoption by 2030. So why the gap? Well, I believe it's for two reasons. One is their mature US base. So BMI already has deep penetration, and its growth in the home market will be steady, but not hyper. And then also the international runway is slower to monetize. Europe has only around 16% AMI penetration today, but BMI's presence abroad is smaller, so it won't really move their consolidated revenue as much, at least in the near term. Looking at the competitive environment, we just discussed two of the big three rivals, but to go into them a little more, Xylem offers global scale and multi-utility solutions, while Roper's Neptune brand is North America focused, and Itron spans electric, gas, and water metering with a broader tech edge. There's then also smaller players like Mueller, Camstrup, and Diehl that compete in niches, but BMI holds a strong number 2 position in US water metering, though it's typically rated outside the top 5 in Europe. Now, at Y Hamilton blog on X has a good blog post, too bad most of it is paid, that notes it uses cellular radios versus competitors like Xylem who use fixed networks. There are some pros and cons to both, but I like the benefits of quicker deployment and lower complexity with those cellular radios from Badger Meter. Doing a little financial metric comparison between the competitors, I used fiscal.ai, and Badger Meter stacks up quite well on revenue and efficiency, but does screen expensive on valuation. Roper has by far the highest gross margins at around 70%, but BMI is higher than the rest of the competitive set. BMI also has the second highest free cash flow margins at 15%, only to Roper again. And BMI actually had the highest 5-year revenue CAGR at 16%. Looking at ROIC, they have a 17.8% 5-year average and a 14.1% 10-year average, which consistently generates higher returns than peers, well above Xylem at around 7 to 9% ROIC, and Itron Roper, which are lower at 5 to 7%. In terms of growth outlook and then valuation, analysts expect BMI's revenue CAGR at 8%, which only trails Roper. Their free cash flow forward CAGR, however, is only around 6%, which is slower than all the peers. And then moving to valuation, they trade at 38 times forward PE and 41 times EV to free cash flow, which is a steep premium to peers. Xylem trades at around 29x and 34x. Itron's at 21x and 18x respectively, and Roper's around 25x on both. Next, we'll tackle 9 questions that outline Badger Meter's quality growth profile, a quantitative look at their predictability, profitability, and long-term value creation. Keep in mind, this is mostly backward-looking to gauge their historical quality, while my full 33-question checklist also layers in some forward-looking factors, and so does the valuation section of this podcast. So first, predictability. Is 5-year trailing revenue stability at least 0.84, which is my weighted portfolio average. And this is a revenue consistency metric that incorporates both trend and volatility from investorsgrow.com. The answer to this question for Badger Meter is yes, as their 5-year trailing revenue stability score is 0.90 as of the latest fiscal year, and actually hasn't been below 0.71 since 2005. Next is their 10-year SBC adjusted free cash flow linearity, at least 0.77, which is my weighted portfolio average again. Yes, it is actually 0.85 from 2015 to 2024. So they get 2 yeses for the predictability section. We then move on to profitability, where unfortunately they actually get 0 out of 2. The first question is 10-year average gross margin, at least 40%, which is kind of my own benchmark, although my portfolio weighted average is higher at around 65%. For Badger Meter, this is where they kind of get dinged a little bit, as their 10-year average gross margin is 38.7%. But it is worth noting that their standard deviation of 1.3% is significantly lower than my weighted portfolio average of 3.9%. And the story is the same for 10-year average SBC adjusted free cash flow margin. I usually like to have a 15% benchmark, and my weighted portfolio average is higher at 23%. And for Badger Meter, their 10-year average is 12.8%, with once again standard deviation being a little lower. Moving on to growth and conversion, they actually get a 3 out of 3 here. The first question is 10-year revenue CAGR at least 5%, which for me is fine for a long-term compounder if they pair it with margin expansion and strong free cash flow or EPS growth. For Badger Meter, this is a yes, as their 10-year revenue CAGR is 8.5%. I then like to find out if their 10-year free cash flow per share CAGR is at least double digits at 10%. And for Badger Meter, this is yes. It's an impressive 19.4% over the last 10 years. To round out this section, I like to look at their 10-year average free cash flow conversion with a 75% benchmark. And once again, they easily clear this hurdle at 128% 10-year average and a median at 124%. The last section of the quality growth profile is value creation, and I give them a 1.5 out of 2 here. The first question is 10-year average combined ROIC, at least 20%, and ideally greater than the industry average. It's less than 20% here at 15.9% with a median of 16%, but it is higher than their industry average at 13%, so I give them a half point. The final question to wrap this section up is combined ROIC trending up if low or holding steady if already high? They get a yes here, as it's been on an uptrend since a dip from 2017 to 2018. Look to X for my full tweet on this question. Overall, Badger Meter scored a 6 out of 9, which is pretty solid, just a little low on the profitability margins. We'll now dive into a high-level overview of their 3 financial statements. First, the income statement. Badger Meter has shown steady margin expansion over the past decade. Gross margins have hovered around 39 to 41% in recent years, and operating margins have improved meaningfully, from mid-teens 5 years ago to around 20% today. Net margins have followed a similar trajectory and are now consistently in the mid-teens, around 15 to 16%, which is a strong level for an industrial tech company. Free cash flow margins are also robust at around 18% trailing 12-month, further validating their capital-light model. The biggest driver of cost of goods sold for Badger Meter is raw materials, especially brass. Over time, the mix shift toward higher margin products has helped offset raw material cost pressure. They report a single selling, engineering, and administration, or SEA, line item, but it's interesting that they also disclose R&D separately in another place of the 10K. Over the last 5 years, SEA has declined from 54% of gross profits to now 46% as of the latest fiscal year. R&D has been stable at around 6 to 7% of gross profit and 2 to 3% of revenue. Together, this structure shows BMI keeps operating expenses lean while still allocating a predictable slice of gross profit towards innovation. I then like to look at interest coverage, but they carry no debt today, so their interest coverage is effectively infinite. Turning now to the balance sheet, their asset base has 4 main line items, and their balance sheet overall underscores a low risk profile with ample liquidity and limited exposure to goodwill impairments. As of fiscal 24, they had $816 million in total assets, with the top 4 comprising around 80%. And those top 4 are cash and equivalents, which is around 36% of total assets. And it's been sharply higher in recent years and is now their single largest line item. We also have inventories, which is around 18% of total assets, and it's been a steady share of assets reflecting stable production and demand. Then we have receivables, which is around 10% of total assets, and it's also been fairly consistent over time. Lastly, we do have a little bit of goodwill, but only around 14% of total assets, which is very moderate and stable, and well below my 30% red flag threshold, and then also below their NYU industry average of 24%. Turning now to top liabilities, as of the latest fiscal year, their total liabilities were $210 million, which is a small balance sheet footprint relative to its total assets. The top 3 liabilities comprise around 74% of total liabilities, and they are long-term deferred revenue, which is 31% of total liabilities. And what's interesting here is this line item only began appearing around 2022 and has grown steadily since. This is likely tied to their growing software and subscription business. We then have accounts payable at around 27% of total liabilities and accrued liabilities at 17%. Total liabilities have risen modestly along with growth in operations, but they remain conservatively financed. Overall, liabilities are almost entirely operational in nature, with no leverage or refinancing risk on the balance sheet. Now, I don't do this for every company, but Badger Meter does qualify for a little bit of inventory analysis. And inventory matters for them because its meters and sensors are hardware intensive. They need steady access to raw materials while balancing finished goods for utility rollouts. Managing inventory well will ensure a smooth deployment and protects margins from supply chain swings. Now, looking at the relationship between inventory growth and revenue growth, the correlation is about 0.59 over the past decade. That's decent, but does have room to improve. The average percent change variance is 7.3%, which is below my benchmark of 10%, which suggests on an average year, there's not too much variance between the two. Days inventory outstanding has also declined from 115 days in 2015 to 105 in 2024, which is nice to see. Looking quickly at some financial stability ratios, Badger Meter is very strong financially. Their debt to equity ratio, 10-year average, is 0.08 and was never above 0.31. And this is way less than my 1.5 threshold and its industry median of 0.24. Cash to debt is also impressive with a 10-year average of 13 and the 10-year median is 6.9, both of which are above my 0.75 threshold. And then latest quarter, they actually have no debt. Then looking at debt to free cash flow, this measures their debt paydown ability. And the 10-year average is 0.75 and the median is 0.14, both which are way less than the typical less than 3 threshold. So very impressive here for Badger Meter. Lastly, the cash flow statement. In 2024, operating cash flow hit $155 million, with that lift coming from contract liabilities and an inventory drawdown. These gains offset a $12 million drop in payables. The pattern here is consistent. When BMI takes on more deferred revenue, which is those multi-year SaaS AMI contracts billed up front, or when they hold less inventory, cash flow spikes. When payables or inventory swing the other way, cash flow tightens. On the cash flow statement, I'd like to look at 2 metrics, SBC intensity, which is SBC divided by revenue, and capital intensity, which is CapEx divided by revenue. For SBC intensity, I like anything less than 10% of revenue, and then I also like to look at operating cash flow. For Badger Meter, they have low SBC intensity. The 10-year median is 0.4% compared to their industry average of 1.4%. And then SBC percentage of operating cash flow 10-year median is also a really low 3.6%, which is less than my portfolio weighted average of 12%. They also have low capital intensity. I like 4% as a benchmark, and my 10-year portfolio weighted average is 4.3%. And Badger Meter compares very favorably here at a 10-year median of 1.9%. And they have been on a long-term decline since 2015, having leveled out at around 1 to 2% of revenue since 2018. Let's now talk about who's actually steering the ship at Badger Meter and whether their incentives line up with long-term shareholders. For those that know the podcast now, I like to classify every company CEO into one of 3 buckets, and those range from most to least knowledgeable and passionate about the business. In this case, CEO Kenneth Bockhorst is best described as a long-tenured manager. While not the founder, he has over 2 decades of experience in industrials and has led Badger Meter since 2018, which is about 7 years and well above the US average of 4.8 years. Turning over to employee sentiment, Glassdoor reviews are also reasonably strong for an industrial company. They have a 77% recommend to a friend rating, which is slightly below my top quartile database benchmark, an 80% approval of the CEO, and 85% of employees have a positive business outlook. They highlight good benefits, strong culture, and work-life balance as positives, while critiques center on cutthroat management style, limited training, and poor communication. I then like to look at executive compensation, and this is more important if insider ownership is low. Bockhorst owns around 98,000 shares, which is 0.3% of outstanding stock, and this represents a $6 to $7 million stake, which is modest, but enough to keep him aligned with shareholder value. In 2024, his total pay was $5.1 million, with only $830,000 in fixed salary, which is about 16% of the total, and the rest was tied to variable bonuses and equity. That mix means pay only rises if performance does. What's also nice to see is that, according to Simply Wall Street, Bockhorst's $5.1 million package is below the US market median of $8.7 million for companies of similar size. The thing that really stands out about Badger Meter to me is their compensation KPIs. Their incentive system emphasizes ROIC and free cash flow conversion, 2 of the cleanest measures of true value creation. Annual bonuses are split 50% between adjusted EBITDA and absolute free cash flow, which rewards both profitability and cash discipline. The long-term incentive plan is equity-based, vesting over 3 years, and 70% weighted toward performance share units that hinge on hitting ROIC and free cash flow conversion targets. For capital allocation, I give the management team a moderately strong rating. While there's no Morningstar report available, they're pretty clear in their investor presentations about their priorities. First, focusing on internal investment to support organic growth. Second, to grow the dividend annually in line with earnings. And third, to accelerate acquisitions that align to strategy and return targets. Given their mature growth business lifecycle stage and industry, I'm okay with their capital allocation priorities. You could nitpick on the emphasis on dividends and lack of buybacks, but there's also not a lot of SBC to worry about. Looking at acquisition intensity, which is acquisition's percentage of operating cash flow, only the 5-year median is higher than my 10% benchmark for low reliance on M&A for growth. It was 6% for 3 years, 20% for 5 years, and 9% for 10 years. With the trailing 12-month, the most outlier time period at 105% due to the SmartCover acquisition. So I'd rate them low to medium on acquisition intensity. In terms of total distribution to shareholders, I like to look at buybacks plus dividends divided by free cash flow. And over the long term, anything below 100% is usually a good sign. And they do score well here on the 3, 5, and 10-year averages. They're all below 100% at 29%, 29%, and 31% respectively. Most of that distribution comes in the form of dividends, which has had a 15% 5-year growth rate. Then looking at shares outstanding, diluted shares outstanding have increased a small 3% from 29 million to 30 million over the last 10 years. It's not really declining and it's basically holding steady. While there are no formal multi-year targets that I could find, management did reiterate in its Q2 25 earnings call a belief in high single-digit revenue growth over the long term. This is something we'll pay attention to as we get to the valuation section. There's also not a lot of report on insider buying and selling. It has been fairly balanced over the last 12 months with a slightly net positive, but a lot of that was reflected in options and award grants rather than open market conviction buys. CEO Kenneth Bockhorst has been the most active, with large award-based acquisitions, followed by some disposals. To round out this section, we like to look at the ownership structure of a company, with my insider ownership benchmark at around 10% and institutional ownership benchmark at around 75%. For Badger Meter, they had 0.5% insider ownership on Simply Wall Street and 3% on Guru Focus, which are both below the benchmark. For institutional ownership, they had a 98% on Simply Wall Street versus a 94% on Guru Focus, which is above for both. So good scoring on institutional ownership and a little light on insider ownership. Let's now dive into a few key metrics that are critical to monitor for this company. The first one that I would look at is SaaS, or overtime revenue percentage of total sales. While BMI doesn't break out SaaS explicitly, it does show up in that overtime revenue line. This has grown to around 55 million in 2024, or 6.7% of sales. Investors should watch this as the margin-rich SaaS stream expands, since it's key to BMI's transition from hardware sales to recurring revenue. The second KPI I would pay attention to is US versus international revenue mix. The US remains dominant at around 90% of revenue as of fiscal 24, but Europe and other regions are potential growth opportunities in the future. Tracking whether they can lift that international share will be important, particularly in Europe, where AMI penetration is only around 16% versus 40% in North America. Let's wrap with some valuation and technical analysis. I use a hybrid valuation approach. Multiples give me a snapshot of market sentiment, while intrinsic valuation methods like DCF act as my long-term compass. Given their current mature growth stage and free cash flow stability range of 0.67 to 0.76, free cash flow valuation methods will be good to use here. And I've also sprinkled in EV to EBIT for a multiple lens. The data ran for this valuation was as of August 27th. First, I ran a DCF on investorsgrow.com using 16 analyst free cash flow estimates. The model assumes a 9% discount rate, a 2.5% terminal growth rate, and 5 years of analyst projections, followed by another 5 years of gradually declining growth at a 12% rate, rather than dropping just straight to that 2.5%, since their last forecast still shows 13% free cash flow growth. Based on that, Badger Meter's fair value comes out to around $129 per share, which is about 32% below the current price of $188. This implies a forward IRR of around 7%. Looking at reverse DCF, which flips the script on a traditional DCF, and using a 20 times terminal price to free cash flow multiple, you get an implied around 14% annual free cash flow per share growth over the next decade. Based on their 3, 5, and 10-year historical averages, this is definitely doable, but it won't be easy to achieve. The last free cash flow valuation method I like to use is SBC adjusted free cash flow yield. And this ties their valuation to their cash generation, excluding SBC, which is really not a concern here. The trailing 12-month Q2 adjusted free cash flow yield is 2.85%. with the 2026 forward yield at 2.94%. And surprisingly, this is actually above their 3, 5, and 10-year medians. So while not cheap in absolute terms, BMI does screen attractive versus its own history. Turning over to EV to EBIT, on a trailing basis, they trade at a 31 times multiple versus 30 times for Xylem and 29 times for Roper, and also a lower 17 times for Itron. Historically, BMI has traded at a median multiple of around 36x, and if we apply that multiple to today's trailing EBIT, we get an implied share price of around $216, which is 14% above the current $188 price. Now, this doesn't necessarily mean it will revert to that long-term norm. Turning over to forward EV to EBIT, I like to use Fiscal AI. They trade at a 29x multiple versus its 5-year median of around 33x. Which implies modest multiple compression, but that is in line with Roper at 27x and still ahead of Xylem at 22x and Itron lagging again at 18x. If you apply that median to forward EBIT, that yields an implied stock price of around $210 or about 11% above today's price. Overall, Badger Meter is priced for strong execution, and while multiples leave some room for a return to historical medians, the bar is already quite high, so future returns will depend more on sustaining growth and cash generation than on multiple expansion. Before we get to the verdict, let's briefly talk some technical analysis. I like to look at the daily 1-year chart and then the weekly 5-year chart to start some trend analysis. And on looking at the 1-year daily, BMI is in a short-term downtrend as it's trading below its 20, 50, 100, and 200-day EMAs, with resistance stacked between 190 to 212. A bearish crossover has formed as the 20-day EMA now sits under the 50 and 100-day EMAs. Taking the long-term trend, the 5-year weekly, it's shifted out of its prolonged stage 2 uptrend and appears to be in a stage 3 topping phase. My stage identification flag sheet flags it as such because price is hovering just below the 50 and 100-week EMAs, but hasn't broken decisively under the 200-week EMA at around $163. Holding that $163 level could set up a stage 1 base, while a breakdown would confirm a stage 4 decline. Their anchored volume profile has a similar outlook, and it shows heavy supply between around $200 and $220, where trapped shareholders will likely sell into rallies, creating some resistance. And then on the downside, there's a high volume accumulation node around $160 to $165, which aligns with that 200-week EMA and making it a potential long-term buy zone. If that level breaks, the next notable support doesn't appear until around the mid-140s. According to MarketBeat, BMI short interest stands at 6.5% of float, with a short interest ratio of 6 days to cover. This places it in the neutral range for me, suggesting a moderate but not extreme level of skepticism among investors. Now, let's turn to my verdict. On a 5-year basis, my base case for total shareholder return is around 10% per year, broken down as 10.2% in free cash flow per share growth, and I got this using 5-year analyst estimates, and a 0% buyback yield, which is in line with historical norms. And then I have a negative 1.4% valuation multiple change using forward EV to EBIT. And then on the plus side, I have them increasing their dividend yield slightly to 0.85% from that slight valuation compression. Now, if multiples compress further and free cash flow per share is closer to $6 by 2029, the bear case is a 7 to 8% TSR, while if the multiples hold at 29x and SaaS tailwinds push free cash flow per share closer to $8, then the bull case gets you 12 to 13, 14% TSR. Badger Meter is right at my TSR hurdle, but quality, valuation, and technicals also matter. It scored an 81% quality score in my general checklist, while its more focused quality growth profile of a 6 out of 9 is pretty solid too. Valuation models suggest a wide fair value range of about $129 to $216, and 5-year technicals indicate that now is not a bad time to jump in, with more accumulation opportunities in the 160 to 165 range. Ultimately, I like that Badger Meter is a pick and shovels play on essential water infrastructure modernization with a long runway in AMI adoption, SaaS contribution, and tailwinds from regulation. There's also the fact that they are an intriguing acquisition target too. Therefore, I've decided to buy a small starter position with the hopes of adding more should the price get down to that 160 range. I would consider selling my position if SaaS growth meaningfully under-delivers, international expansion stalls, or if competitive or structural pressures emerge, like margin erosion or share loss to Xylem or Itron. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Badger Meter both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at Invest091. Join me next when we'll dive into Tyler Technologies, ticker symbol TYL. Until then, keep your investments smart.